Welcome back. We've been discussing with three experts what will be the impact of the Reserve Bank having to report to government the fact that they have failed. Will the contents of the letter weigh on them in policy making? And more importantly, the FOMC changing changing its language to become more hawkish, if not the FOMC, at least Jerome Powell. I've been speaking with Samiran Chakraborty, Soumya Kanti Gosh and B Prasanna. Gentlemen, thank you for your patience. Well, Prasanna, basically now should we be prepared for more rupee weakness considering that the FOMC has turned hawkish?
Lata, that's, I think, obvious if you leave it to market forces. Obviously, the rupee will be a little bit on the depreciating bias. Just take into account the fact that the dollar index went to 114, then came down all the way to 110. And that was when the expectations of the slower rate trajectory from the Fed was getting factored in. But what was clearly not factored in the global markets is the fact that there will be a higher Fed fund rate as well. So now what this has done is since the Fed meeting is that the dollar index is again started, appreciating, and which means that there will be a depreciating bias to the rupee as well. But what is clearly not known is what is going to be the extent of RBI's, intervention and at what level they're going to be really coming in and protecting the rupee, if at all. Mm-hmm. And one would have to assume that since they have actually spent quite a bit of reserves in the last 6 months, they would probably not have that much or wouldn't want to use as much ammunition that they've used in the past. Mm. So I guess it's a little bit of both, let it depreciate a little, but also come in and, kind of prevent huge volatility while it's depreciating. Okay. Keep in mind that the current account deficit is very much on the higher side still.
Soumya, would you concur that the market, the Indian economy, business people, India Inc. has to be prepared for a slightly higher depreciation? Do you have any number or range in mind for, say 2023 or just for FY23?
No, I think the rupee will continue to have a depreciating bias, and I think this there has been a slight shift in the Reserve Bank strategy. I think the last 2 months when they allowed the rupee to weaken below 80 because the NDF market was already showing the rupee below 80 in August, but the RBI was holding until the end of September. So my sense is that yes, there will be a weakening bias in the rupee, but what is important to understand is that at the end of the day, how far the central bank allowed. So it will actually be a very delicate call between maintaining a value of the rupee and ensuring that at the same point of time, it has not a significantly impact on the inflation. But my sense is that yes, there will be an impact on the value of the rupee.
Okay, for FY23 itself, should we be prepared for say 84, 85?
It's difficult to say, but one good thing, Lata, is that I think current account deficit last time was a positive surprise. And I think one of the factors which has acted as a counter-cyclical response to a deteriorating current account deficit was the private transfers. So if that plays out, we may get a current account deficit number which is higher than the market projections in more than 3.5%. Okay. The RBI is maintaining it at 2.8%. So that could be one of the positive surprise which could hold back the rupee depreciating to a significantly lower levels.
Samiran, the Bank of England has also raised by 75 basis points. So there is a tightening, a serious tightening bias the ECB has already done, and now the FOMC's peak rate is likely to be 5.5 or some, 5 quarter or 5.5. Given that, should we be prepared for a higher current account deficit and therefore more pressure? Destination countries are tightening seriously.
On one hand, we have to deal with this somewhat unique situation where global growth is slowing down, but India growth is holding up. And that growth differential is causing our current account to stay relatively elevated. But on the other hand, in funding this current account, among multiple sources of funding, one particular source is going to be challenging, which is the ECBs and all, where whatever external loans will come up for refinancing going forward, there will be a tendency for people to try to shift from dollar into local currency borrowing, given that the interest rate differential has shifted quite a lot, and there is expectation of further currency depreciation, etc. So how then will you find the current account deficit, even if hypothetically current account deficit stays just about 3% of GDP? Would it mean that then the balance of payment deficit will continue much beyond FY23? And then what does RBI do on the FX intervention side? While all this is theoretically correct, one thing we should not forget is that RBI has not as yet started using any capital account measures on capital controls to restrict capital outflows, as well as encouraging more capital inflows. A central bank always has multiple levers to play with. So I would not be looking too far ahead to predict how this situation is going to pan out. RBI has pretty high number of levers to control the situation if it feels that the FX reserves has declined beyond the critical threshold.
Yeah. And they're, of course, approaching all this from a position of strength. It's not a back-to-the-wall situation at all. I mean, we are running out of time, but to come back to where we began this conversation, the RBI report to the government. Soumya, do you think that now the terrain in December could be very contentious? We know that two external members are pretty dovish. Dr. Verma wants it to stop at 5.9 or at 6%, the repo rate. But now, faced with what the Fed is doing, the RBI, as all of you are saying, is, there is an upward bias to the rate hikes. So does that make the December and subsequent meetings very contentious, with external members not bothered about, the rupee so much, and RBI, turning out to be more hawkish?
No, I think that's a very valid question. And the most interesting part is that the December Fed meeting is perhaps, I think, after the RBI meeting in December. So that will actually make the things even more complicated. So, but my sense is that it may not be, it may not be the appropriate to think of actually going for a maybe shorter rate hike at this point of time, because things are very uncertain. There could be rate hikes by the Fed in December, in February. So it is better to stay safe than to say sorry at some point of time. Because at the end of the day, we all know that what happened to US when they termed this as transitory inflation and then had to retreat and hike rates so as to contain.
Okay. Well, out of time. Samiran, will it be contentious? Very quickly.
You mean the letter or the policy decision?
The December meeting, because it looks like the external members are dovish, but RBI has other problems.
Yes, we have already started seeing a divided voting pattern in the FPC, so I'll not be surprised if that division continues in December.
Okay, we are out of time, but thank you very much for a very interesting chat. The important part is the FOMC's behavior, Jerome Powell's statements clearly indicating a higher terminal rate for the US Fed funds rate is likely to give an upward bias to the peak repo rate in India. And that has a lot of consequences for the economy. We wrap up on this edition of Indianomics. Thanks much for watching.